Hi, my name is Harshit and I'm working as a risk analyst with one of the MNC bank in India. Today I'm going to talk about what is risk, what is the importance of risk, why do banks and corporates need to manage risk, and how does it impact your financial statements or any kind of business we do. So, first of all, understand what is risk. Risk is nothing but the uncertainty, the probability of an event is happening because of which we'll end up having losses. Now, if I talk about uncertainty, there is a common difference between uncertainty and risk, which means uncertainty is something which is not been quantifiable as of now. That means which doesn't tell you how much risk you're going to end up having. But risk tells you at least an amount of value that it will occur if a loss happens or an event happens. Now, these are more related to the probability concept, which tells you that what is the probability that the event will occur, and if this occurs, what will be the losses, right? Now, this is basic risk. That means it could be any kind of risk. If I talk about in financial terminology, it could be your default risk, counterparty risk, market risk. We'll talk about it. What are these? Now, moving to the type of risk, the one we were just talked about. There are four broadly type of risk. The one is credit risk, market risk, third is operational risk, and fourth is regulatory risk. Now, what is credit risk? Credit risk basically is a risk which happens or occurs because of default in the payments. So as you already know, the banks has a core business of taking deposits and lending it to the borrowers or any kind of credit lending in that matter. Now, the first one comes is called default risk, wherein there is a chances that the customer who took money from us will not pay back, right? And eventually it's depositors' money, so bank is also owning a liability. Not necessarily it could be a depositor's money, it could be a investment from some investor or a capital raised through something, but it is again a liability. This is called default risk. Now, the second one comes in, which is counterparty credit risk. It's again a part of your credit risk, which comes primarily from the counter derivatives, right? Because in that cases, all the deals are happening over the counter, and you do not have basically a lot of regulation around it, so that you can understand and get some claim out of it. So that is over the counter, where the full faith goes to the other counterparty, right? So this is called credit counterparty risk. Now, the next one is market risk. Market risk is something which occurs because of change in the market situation or the market condition. Specifically, if we talk about, there could be a change in BSE Sensex or NSE Nifty. Now, if you have a position in any of these markets or any of these trade, you're going to end up having losses or gains because of the change in the index value, right? So there are 2-3 broad sections within the market risk. One is interest rate risk, the other one is liquidity risk, and then you have foreign exchange risk. We'll talk about it one by one. Liquidity risk is something when you have a risk of selling your asset but not getting materialized. So what I mean to say is the liquidity of that product has gone down. That means no buyer is available in the market, and hence you cannot sell it. What is liquidity from accounting terminology? So liquidity is how soon you can convert your asset into cash. And if that soon is not possible, then you are basically dealing with a liquidity risk. That means your asset is no more sellable, right? Now, the next comes is interest rate risk. Now, before we go to interest rate, we need to understand how does this interest rate impact us. And why I'm saying, because if we don't understand the bond valuation concept, we will not be able to understand the interest rate. Bond is nothing but a kind of debt security. It could be issued by the government or the corporates. The valuation of bond is primarily dependent upon the interest rate, and these are inversely relation. That means if the interest value goes up, your bond value will go down, and if the interest value go down, your bond value go up. Now, coming back to the interest rate risk. Let's assume you are dealing with a debt portfolio which includes a lot of money market instrument, bond, or the government securities or corporate bonds. These all bonds are tradable in the market. Now, if interest rate goes up, there are chance that value of your bond will go down. Now you are again dealing with a risk, right? Now, when you're dealing with the risk, you have to make sure that you have certain hedges in place so that you are basically nullifying the effect of change in the interest rate. Now, the next one comes is the foreign exchange risk. Foreign exchange risk is a part of risk when people or basically the banks are dealing across the border. That means the conversion in USD, yen, yuan, pound, or anything. Now, this is a risk because it materialized and it changed the value of your asset. Right? That is what the foreign exchange risk is. Now, moving to the next, which is an operational risk. Operational risk is a risk wherein a risk could potentially occur because of any manual intervention, any processes, any system, or any external event. How it will occur, we'll talk about it. Let's assume you're working for a trade, and within that trade, your investor or your client has asked you to put a trade of 1,000 rupees. But by mistake, in hurry, just to make sure your trade goes on time, you put an order of 10,000 rupees. Now, whose mistake it is? It's client's mistake, right? No, it's not client's mistake, it's our mistake. Right? And that is operational risk, because of which the losses which are going to occur, your firm is going to face those losses. Right? Now the next is called process risk. Nowadays you will be seeing that a lot of banks are getting into a KYC documentation, right? Just to understand that what kind of customer they are dealing with. Now, if there is a flaw in their process, right? Probably they are taking a fraudulent documentation. They are not able to understand if the documentation is fraudulent or not. They may end up having a prime or subprime customer. That means they're going to end up losses because that customer is not going to pay them back. Right? So this is a risk which is yielding because of process. System risk, one classic example of it, your IT infrastructure is not good. That is more prone to a cyber attack. And cyber attack could basically yield you a lot of risk, and they can take your data away from you. System risk. And then you have external event. External event is like there is a terrorist attack or there is a flood in somewhere and you have a facility out there and you are not able to perform your day-to-day business operation. Now, how the company deals with these kind of risk? Now, first we'll talk about people risk. Nowadays, a lot of banks and companies are doing succession planning, or we call backup planning, so that if a person goes out, you have somebody else to replace him and perform the same duties, right? And the another one is we talked about just is a process risk. So process risk nowadays, a lot of banks are putting in money so that they can create process map and understand where the loophole areas are, and so that they understand that if there's a loophole area, what is the risk involved in it, and they can mitigate that risk. Then we have system. A lot of firewall and IT infrastructure amount has been raised so that they can build good firewall and cyber threat can be stopped. And then you have external event. To deal with the external event, the companies are nowadays doing a BCP testing. The BCP is nothing but a business continuity planning, wherein they create backups on different locations. So if a company is primarily in Gurgaon, they will have a facility in Chennai or Mumbai, so that they can interact with those people, and if something happens to one facility, work can be done from the other facility. So this is three risks we just talked about: credit risk, market risk, and operational risk. The one last comes in the picture is regulatory risk. And regulatory risk is nothing but it's more to deal with the regulators. You would have understand after 2008 subprime crisis, regulators are very strict in nature nowadays, right? If you talk about BCBS, Banking Committee for Banking Supervision, Basel Committee for Banking Supervision, they have come up with a lot of Basel rules. We'll talk about. So Banking Committee for Basel Committee for Banking Supervision had come up with a lot of rules, wherein all banks have to follow those rules. If we talk about specifically in India, we have a lot of rules by RBI which all banks have to follow, and especially the KYC, Money Laundering Act, etc., etc. These guidelines has to be followed by all the bank so that they are doing what is expected. And if they are not doing and regulatory caught them, they will basically have to pay fines. Now this is regulatory risk primarily. So we have already talked about now that 4 type of broad risk: market risk, credit risk, operational risk, and regulatory risk. Right? Now let's understand how this regulatory risk or other type of any risk impact the bank and what impact they have in the financial statements. Right? Now let's understand how this credit risk work. In credit risk, at the first of all, you have to understand what is the probability of default of the customer. When I say probability of the default of the customer, you need to understand what are the chances that customer will default in next 12 months. When I say specifically 12 months, that means if a customer is taking a loan today, what would be the probability that it will default in next 12 months? And 12 months is a guideline given by BCBS. And what was BCBS? We just talked about BCBS is a banking committee for Basel Committee for Banking Supervision. Right? Now, if we are following to understand PD, we know the chances. The next thing we need to understand is if a person default, what would be the losses? Now, to deal with this, we have a terminology called LGD. LGD is nothing but loss given default. Let's assume if I lend something to a customer, I know the probability of default, I know the loss given default, I can understand what my expected loss in percentage terms. LGD is nothing. For example, I'll give you to understand well on LGD side. Let's say you have lent 1,000 rupees and you are expecting 100 rupees every month. And at the time of 6th month, the customer paid you, but 7th, 8th, 9th, 10th month onwards, he doesn't pay it back to you. So you have received, broadly speaking, around 60% of your money and you're just expecting 40%. Very basic example to understand LGD, your LGD would be 40%. And in this case, if your default is, probability of default is 1%, so your expected losses would be 1% multiplied by 4%. 40%. So that is basically your expected loss. The last thing comes in the EAD concept is EAD in credit risk. What is EAD? It's exposure at default. That means if your loss happens, what would be the exposure? Now exposure includes the opportunity cost or the expected revenue. That means if there is an interest portion in it, it will be added. To understand interest rate or to understand the EAD portion, we need to understand what is a credit conversion factor, which also banks call CCF. The credit conversion factor is nothing but the expected value of total loan getting drawn over the period of time. That means if we, in our example, we know that 1,000 out of 1,500 has been drawn, 500 is still pending. We try to understand what is the probability or what is the chance that this 500 will get drawn. So we take credit conversion factor. So once you have your PD, LGD and EAD in place, you just multiply them and you will get the value as expected losses. Now how expected losses will impact you? Since you already know your expected loss, the bank generally put provision on it. And this is very basic understanding of it, just to understand how they are doing. However, while doing the actual provisioning, it's not that easy. Bank actually need to understand what is their cash inflow or rather expected cash inflow and then discount it at the rate, maybe the contractual one or the regulatory one, and then understand what is their realized value, and basis that they put provision. But on a portfolio level, just to understand what is your expected losses and what could be your closed provision would be, it is a good approach to understand. Right? Now once you have EL, you can do provision, and that's how your credit risk get covered. Now what about market risk? Because there you have a dependency on the fluctuation in the market and you cannot do PD, LGD and EAD calculation. You can do LGD in counterparty thing and derivatives, but what about the index driven things? The tool which I used there are called VAR, which is value at risk, SVAR, stress value at risk, or ES, expected shortfall. These are few examples of these risks, not necessarily that only restricted to this. There are a lot of methodologies, terminologies are being used in market risk nowadays, which actually tells you what is the value of your asset is at risk. That means because of change in volatility in the market, how much fluctuation will happen to your value, and you can understand the percentage change and do a cover of it. One instance that in derivative aspects, banks do delta hedging, right? Delta hedging is nothing but they basically see the underlying value, change in the underlying value, and then see what is the change in the option or the derivative price, and they hedge according to that. That's how you cover your market risk. One of the example of market risk we just talked about. The next comes as an operational risk, right? But before we move to operational, we need to understand how market risk impact our financial statement. So the one we've got with the expected losses, it covers the provision. Now market risks are actually dependent upon the volatility. That means they will be unexpected in nature. So we'll have to keep an economic capital for it. And once we keep economic capital, our total capital would be expected losses, that is provision plus economic capital, which you're keeping. Right? The next is operational risk. We already discussed briefly about operational risk, and they also have to do similar analysis. But the tool they use, like RCA, risk control assessment, they also do BCP testing, they do process reviews and make sure that everything is in place. And the regulatory risk, of course, if you know that there is some subprime loans you have sent, or as a part of bundle, maybe doing the securitization you have sold off during that period, and there is some claim or you have been sued in the court, you know that what type of litigation expense is going to occur, and you take a provision of those litigation expenses in your books. So these are the few ways these risks can impact your P&L or the balance sheet. Now, since we're talking about the financial statements, let's try to understand how our capital works and what is the regulatory capital in that nature. Because nowadays, if we talk about, especially the global bank, they are dealing with the regulatory capital, and everybody just looking for to keep regulatory capital, their capital adequacy ratio and everything. We recently just talked about BCBS, that was Basel Committee for Banking Supervision. Now, what they does, they came up with the Basel rules somewhere way back in 1995 or 1998, I guess, with the Basel 1 set of rules. What happened in Basel 1, they basically started with the very standardized approach. When I say standardized approach, they asked bank, okay, you are lending, that's fine, but basis on the collateral, I'll give you some percentage to calculate your risk-weighted asset. Risk-weighted assets are nothing but risk involved in the asset you are lending or the collateral you have against those lending. For instance, if you have an unsecured loan, you do not have any collateral, that loan is fully unsecured. We'll take an example of mortgage. Let's say if you have lent a mortgage on 80% loan to value ratio, that means you have 80% of risk weight in simple language. So what BCBS said, okay, if you're lending, that's fine, but you have to assign weights given by us. And they divide these rates into certain categories. For example, cash 0%, mortgages 50%, unsecured 100%, and if it is project finance or a specialized lending, it is 100% and 150% based on the stage of the project. Now, when banks started doing this, they came up with the problem that if a loan is very good, then also we are giving the same risk weight, and if it is not that good, then also we are doing the same risk weight. That means there is an underestimation and overestimation of a capital in these scenarios. Now they thought of doing some different approach. They thought, okay, why can't we move to another approach by calculating these risk weight on our own? And to calculate those risk weight, they need to have a PD, LGD specifically. When this news reaches to and the feedback goes to Basel committees, they thought of some new set of rules. And those new set of rules were nothing but Basel II. When I say Basel II, they came somewhere in 2000, and looking at all the scenarios of the 2008 subprime crisis, they come up with two different approaches. The first approach is AIRB and FIRB. These both approach comes under IRB approach. It's nothing but internal rating based model. AIRB is advanced internal rating based model, and FIRB is foundation internal rating based model. Now, if we talk about FIRB, the BCBS said, okay, I'll give you a freedom under Basel II to calculate your PD, But for LGD and EAD, you have to use the risk weight asset which I'll give you, or the percentage which I'll give you. Banks, okay. But this approach was also not good because in LGD estimation, again the over or underestimation was happening. So they, under AIRB, they mentioned, okay, if you want to do the full calculation, you can go ahead and do, given you have that infrastructure in place. But the only thing you have to do is to follow 3 pillars. What is 3 pillars? Under Basel 2, we have 3 pillars, comes as pillar 1, pillar 2, and pillar 3. So pillar 1 says the capital requirement, which is also called capital adequacy requirement, CAR. CAR is nothing but 8% of capital. So BCBS says, okay, if you are basically lending and whatever is the risk weight you are calculating on your own, you have to calculate minimum 8% of capital in your books as the regulatory capital. Now they came to the second pillar, which is pillar 2. They said, okay, once you have the capital and since you have your infrastructure on your own, there will be a supervisory review. And under that supervisory review, somebody from the regulator will come and make sure that whatever practice you are doing is correct. One of the example is TRIM, which is targeted review of internal model. In those scenarios, somebody from, let's say, ECB or European Central Bank or CBI, Central Bank of Ireland, or PRA, which is Prudential Regulatory Authority, comes to the bank, or it could be Fed in US matter or RBI in India. They will come to your bank, they'll tell you this data I need, I want to review or this particular model, and they'll find out problems and will let you know if there's anything. And they signed off the full process. This is called supervisory review. And within supervisory review, what happens that if there is any problem, they call it out properly. They could be that you have to change the approach of AIRB to FIRB for that particular product, or maybe the full portfolio in your bank if you're not capable of doing it, if the supervisor thinks that you're not capable enough to do the calculation. So this is pillar 2. Now within pillar 3, they said you have to disclose your all the risk weight asset with the backtesting of your model to the street. And when I say to the street, that means along with your financial result. Now just try to understand what they did and how smartly regulator had played. They've said, okay, if you want to calculate on your own, we will basically, you'll have to maintain the capital. So capital is anyway going to get maintained 8% under Basel 1 and Basel 2 as well. But we will do a review of your process within supervisory review pillar 2, and you'll have to do the market disclosure as well. Right? So this comes under Basel 2, pillar 3, pillar 1, pillar 2, pillar 3 process. Now moving from Basel 2 to Basel 3, Basel 2 has again certain problems in it. So for example, it didn't talk about the leverage ratio. Again, it didn't talk about the basically your funding ratio, stable funding ratio of a bank. So liquidity ratio, we already had discussion. Leverage is again a problem with the bank because sometimes banks take lot of leverage on their position to make profit. They restrict it to 3% in Basel 3. And then the another thing was on the line of your stable funding ratio. They also tried to understand, okay, we are talking a lot about capital. What if something goes down? What if businesses stop? What is the stable funding of a bank for 30 days, 60 days? That means if there's no operation, how far can bank run without any input of money? They also try to understand that. So by doing all these, they basically understand what is the capital requirement, how much capital we need in the stress scenario to make sure, and if anything goes wrong, depositors' money is safe. Now to do this, they also started providing the stress scenarios. We just talked about something, a word called stress. Stress is nothing but pushing a variable down which will impact your capital. It's nothing but a scenario analysis in financial terminology, or a stress testing in risk terminology. For example, if I say your GDP goes down by X%. Now, if your GDP goes down by X%, what will happen to your business? If your business will go down, that means people will not come for money, or they will stop, depositing money. If they stop depositing money, you will have less money to lend. You will be basically running out of capital. And if you're running out of capital, how would your regulatory capital looks like? So banks have to follow a scenario given by the central banks, and they have to stress. So you might have read or you have heard about it that Citibank had failed the stress test by X depositor or X government or something like regulators, and these are the tests they perform, and then they publish result that okay, this bank looks good in terms of capital, but they're not good in a stress scenario, right? So this is how banks are being managed from the regulatory point of view. Since we are talking more on the regulatory framework, there is something newly came up in 2018, and nowadays banks are basically trying to follow that, and that has a lot of impact in their provisioning. Now that is nothing but the IFRS 9. IFRS 9, before going to IFRS 9, we need to understand what is IFRS. So if you have not heard of it, it's International Financial Reporting and primarily used for reporting standard. So when I say reporting standard, you have US GAAP, Indian GAAP, UK GAAP. So all the banks or companies, according to a territory where the sovereign they are operating, they report according to those state requirements. But what if you try to compare them? You'd all not be able to compare their P&L or a balance sheet because the accounting treatment they are doing are different. Now what IFRS says that there are set of rules you need to follow, and if you are following those rules, you are okay. And now you can compare those financial statements. So for example, SBI and let's say Bank of America is coming out as a syndication loan to a company in UK, and syndication is just basically consolidation of a loan and supporting loan to that bank. Now let's some analyst sitting on the UK is trying to evaluate SBI and Bank of America, and they're trying to compare how these two stand to each other. They will not be able to do unless they are not following IFRS. Now moving into the risk scenario, which is IFRS 9 in our case, which talked about the loss calculation. Remember I talked about 12 months in just a couple of minutes back. So 12 months is a requirement from Basel, which is IRB, or you say rating based models. But in IFRS 9, they divided all the portfolio into 3 stages. The first stage is good book, which is very good, no problem with that. You're grading it every year, or you're rating your customer as per requirement, and there's no change in the PD. When I say PD, that means the credit quality is not deteriorating. IFRS 9 says okay, if there is a significant deterioration in the credit quality of an asset or any borrower, you need to move them to stage 2. And the difference between stage 1 and stage 2 is stage 1 has to maintain capital or understand the losses for 12 months as per Basel rule. But once it is a deterioration happens and it moves to stage 2, all the loss calculation will be for lifetime. Lifetime definition bit different for each and every bank, and few of them are considering 10 years, 15 years, 5 years based on their portfolio, but they have to do this calculation for lifetime because there is a deterioration. This is called second stage. In third stage, it's default. That means if a company or the counterparty or a borrower has already defaulted, you will put them under stage 2 and within stage 3. And stage 3 is anyway default, so you'll have to calculate their losses for lifetime. So you need to understand their term structure, you need to understand how much cash inflow was expected, and then discount it back to your current scenario and make sure that this is the realized loss. Right? So this is IFRS 9. So if I just recap my session, whatever we talked about what is risk, we talked about the importance of risk, we talked about type of risk. We also talked about what are the subset in these 2 risks, credit risk, market risk, operational risk, regulatory risk, what are the set risks they have. Then we talked about the importance of each risk and how do they impact our P&L, very high level. We also talked about the regulatory risk and how this regulatory risk is important for a lot of banks nowadays. And we also discussed the regulatory framework around it. So we talked about BCBS, we talked about Basel 1, Basel 2, 3 pillar of Basel 2, we talked about Basel 3. There is an expectation of Basel 4 coming into picture. A lot of talks going on nowadays, but I haven't heard anything very significantly or evidently in nature. However, there could be one coming in. And then we talked about IFRS 9, especially a bit of introduction to IFRS. Hope it was a helpful session for you. You now have an understanding of end-to-end risk at very high level, and you have to read a lot because risk is a very dynamic in nature. And nowadays, so just try to understand, the more locks you create, there are a lot of keys are being created by different people. So it's not that you create something then it will work for lifelong. You have to keep understanding the behavior, nature of the type of risk you are involved into, your portfolio, your business involved into, and then only you can mitigate those risks. Right? Thank you so much. Well done. Good luck.